As we navigate the ever-changing landscape of the real estate market, one thing is becoming increasingly clear: plummeting mortgage rates are having a profound impact on home values. But what does that really mean for you and your property? To understand the significance, let's take a step back and examine some recent trends. In 2022 alone, we've seen mortgage rates drop by over 1%, which may not seem like a lot, but trust me, it's having a ripple effect across the market. In fact, according to Freddie Mac, the average 30-year fixed mortgage rate is now at its lowest level in years, dipping below 3% for the first time since 2012. This downward trend is being driven by a combination of factors, including inflation concerns and a weakening economy. But what does this mean for your home's value? Well, experts are warning that plummeting mortgage rates could lead to a surge in housing prices. Think about it: with lower interest rates, buyers can qualify for larger mortgages, which increases demand for homes. And when there's high demand and low supply, prices tend to rise. Take the example of San Francisco, where median home values have skyrocketed by over 25% in just the past 2 years alone. And it's not just tech hubs like San Francisco; cities across the country are seeing similar spikes in housing prices. So, what does this mean for you and your property? If you're considering selling or buying a home, it's essential to understand how these changing mortgage rates will affect the market. The mortgage market has undergone a significant shift in recent months, with interest rates plummeting to historic lows. As of our last update, the average 30-year fixed mortgage rate was sitting at around 3.5%, down from a high of over 7% just a few years ago. This drastic decline is having far-reaching consequences for homeowners and potential buyers alike. To put this in perspective, consider the impact on monthly mortgage payments. For example, let's say you purchased a $300,000 home with a 20% down payment 5 years ago when interest rates were around 5%. Your monthly mortgage payment would have been approximately $1,400. Fast forward to today, and with rates at 3.5%, that same payment would be reduced to around $1,200. This might not seem like a significant reduction, but it's essential to remember that these savings add up over the life of the loan. The effects of plummeting mortgage rates are being felt across various demographics and geographic regions. First-time homebuyers, in particular, are benefiting from lower interest rates, which enable them to enter the market with reduced financial burdens. According to data from the National Association of Realtors, 38% of first-time homebuyers used an FHA loan or other low-down payment mortgage product last year. This trend is expected to continue as more buyers seek affordable options. However, not all segments of the housing market are experiencing equal benefits from lower interest rates. For instance, in areas with rapidly increasing property values, such as coastal cities and popular urban hubs, high-end homeowners may see their equity increase at a slower pace due to higher loan balances and decreased appreciation rates. This dichotomy highlights the importance of understanding how mortgage rates affect your home's value and long-term financial prospects. The current mortgage rate landscape is a stark departure from the past decade's trend. In 2018, rates plummeted to their lowest point since 1962, with a 30-year fixed rate dropping to 4.34%. However, it was in 2020 that we saw the most significant decline, with rates dipping below 3% for the first time ever. The Federal Reserve's decision to slash interest rates has had a ripple effect on the mortgage market. The Fed cut its benchmark short-term interest rate 3 times in 2020 alone, bringing the federal funds rate down to nearly zero. As a result, banks and lenders have been forced to offer lower mortgage rates to stay competitive. This downward trend is evident across various loan types. For instance, Freddie Mac's primary mortgage market survey shows that the average 30-year fixed mortgage rate has dropped from around 4% in early 2020 to just over 2.8%. Meanwhile, the 15-year fixed mortgage rate has plummeted from approximately 3.5% to below 2%. The implications are significant for homeowners and potential buyers alike. With mortgage rates at historic lows, home buyers have more purchasing power than ever before. However, this also means that housing prices have become increasingly detached from their underlying fundamentals. As we'll explore in further sections, the consequences of these low interest rates will have far-reaching effects on the real estate market and your home's value. As we've established, the rapid decline in mortgage rates has far-reaching implications for homeowners and potential buyers alike. But what does it mean for your home's value? Let's dive deeper into the numbers. Studies have shown that when mortgage rates drop by just 1 percentage point, home prices can increase by as much as 10%. This is because lower interest rates make borrowing more affordable, which in turn boosts demand for housing. According to data from Zillow, a 1-point decrease in mortgage rates can result in a $2,400 increase in the median home value. To put this into perspective, let's look at what happened during the Great Recession of 2008. When the Federal Reserve lowered the federal funds rate from 5% to near zero, it triggered a housing market boom. Home prices skyrocketed, and by 2012, the median home price had increased by over $50,000 in some areas. But here's the thing, lower mortgage rates don't necessarily mean higher home values in every market. It really depends on the specific location and economic conditions of that area. For instance, if you live in a city with high demand and limited supply, even low interest rates might not be enough to drive up prices. So, what can homeowners do? Well, for those looking to sell, plummeting mortgage rates could actually be a blessing in disguise. With lower borrowing costs, buyers are more likely to stretch their budgets, potentially driving up sale prices. On the other hand, for those planning to stay put, it's essential to keep an eye on your local market trends and adjust your expectations accordingly. One expert who has been vocal about this phenomenon is David Stevens, former CEO of the Mortgage Bankers Association. He emphasizes that lower interest rates can have a multiplier effect on housing prices, but warns against getting too carried away with expectations. Now that we've explored the effects of plummeting mortgage rates on affordability and buyer behavior, it's essential to examine how these changes are influencing home values. A recent study by CoreLogic reveals a stark contrast between areas with low mortgage rates and those without. In cities where interest rates have dropped significantly, like San Francisco and Los Angeles, median home prices have increased by as much as 10% year over year. Meanwhile, areas where rates remain relatively high, such as parts of the Midwest and Southeast, are experiencing a decline in home values. For instance, according to data from Zillow, the median value of homes in Chicago decreased by nearly 5% over the past quarter. This divergence highlights the critical role mortgage rates play in shaping local real estate markets. Experts like Mark Fleming, chief economist at CoreLogic, argue that low interest rates create a snowball effect, where increased purchasing power and reduced costs for buyers lead to higher demand and subsequently drive up prices. Conversely, areas with high interest rates face decreased demand, which can cause home values to plummet. This dynamic is evident in the current market, where some regions are witnessing double-digit growth in median home prices while others struggle to maintain even a modest increase. It's worth noting that the impact of mortgage rates on home values can be both immediate and long-lasting. While lower interest rates may attract buyers and drive up demand in the short term, they can also lead to unsustainable price growth if not accompanied by fundamental changes in the local economy or supply chain. As we navigate this complex landscape, it's crucial to understand how plummeting mortgage rates are redefining the relationship between affordability, buyer behavior, and ultimately, home values. As we've discussed at length throughout this video, plummeting mortgage rates have a profound impact on the real estate market. With interest rates at an all-time low, homeowners are facing an unprecedented opportunity to refinance their mortgages and potentially save thousands of dollars in interest payments over the life of the loan. But what does this mean for your home's value? In reality, it's not just about saving money, it's about creating a more stable financial foundation. When you refinance at a lower interest rate, you're essentially reducing your monthly mortgage payment,